And welcome back to the Financially Simple Experience. I'm your host, Justin Goodbread. Today, we're answering the big question, what is a profitability gap? That's right. So if you remember, we spoke not too long ago about this idea that we business owners are often stressed. We're often, stress is not the word, is it? We're often frustrated. We're often can't sleep at night. We have these fears that keep us up. We're talking about these calculations that we need to understand in order to help alleviate some of the concerns that we business owners face. And another calculation I want to bring to you is this idea behind a profitability gap. Profitability gap. And so you hear the term gap, you're going to automatically think in your mind's eye, the wealth gap. Yeah, we spent some time talking about the wealth gap, and I'm not going to go back and repeat all those episodes, but we know what a gap is. You may say, I have a gap in my teeth. I have a gap in my clothes. I have a gap somewhere. Aha, I see gap in the clothes. You see, I did that there. I wasn't talking about the store there. And we have a gap, so we have to bridge it. Whenever we're talking about profitability gap, we're actually looking at, is our company as profitable as it could be? Have you ever thought about that? Have you ever thought about what would your profit look like if you were a best-in-class business? Would you be making more take-home money? Would you have more money going in your pocket? Profitability. You said, man, Justin, about freaking time. Yeah, I've been listening to you for 4 years and I've yet to hear you say that. Yeah, now's the time for us to talk about this. How do we get more money in our pocket directly? The answer lies in this idea around profitability and the gap that we could focus. So in order for me to explain this calculation, I need to teach you a little bit. So I'm going to teach you basic income statement accounting. You say, what is that? Well, if you remember, there's two basic types of statements that we use in the business world. We use a balance sheet, which tallies up all of our assets and liabilities, and we use an income statement. Sometimes people call it income statement. Sometimes they refer to it as a profit and loss statement. So in this income statement, what we're looking at is a couple of major headings. I was actually talking about this today on an interview with a national publication. They were talking about, Justin, how do you track this as a business owner through your mind? So I'm going to overly simplify this. I'm going to tell you in my next book coming out, I'm going into detail on this, on how you can drive this particular concept home to bring home the bacon, as my pops would say. Hey, we can bring home the bacon, son. I'm going to work to bring home the bacon. This is a method that you can use. So let's think about your income statement or your P&L, your profit and loss statement, depending on which one you use for your business. The very top of the statement, you're going to see your revenue. That's how you get paid, how much you get paid. So let's say hypothetically that your revenue is $82,000, $82,000, maybe it's $90,000, whatever the number is. Let's say it's relatively small for our example today. You have revenue coming in for your services that you provide. Well, right off the top of the revenue, you potentially, not everybody's going to have this, but you potentially could have cost of goods sold. We call it COGS, C-O-G-S. You could have an expense there for the cost of goods sold. I mentioned oftentimes my brother. He and I just took a fantastic elk hunting trip to Colorado. We spent 2 weeks together in the backcountry in the truck, had an unbelievable time. Love my brother. It was a great time for he and I to connect. And he has a swimming pool business. So in his profit and loss statement or his income statement, it actually shows a cost of goods being something like chlorine or rebar or concrete. Okay, so he has these things that he pays for that ends up being the goods, the cost of the goods that he sells to somebody else. So that's a COGS. So you have your income minus potentially cost of goods. The reason why I say potentially is not all businesses have cost of goods. Some people, like a lawyer, they're typically not going to have cost of goods. They have revenue and they have expenses. So in this particular case, we're going to say we have revenue, we have our income, minus our cost of goods, and that gives us what we call gross profit. So let's use a number here just for mathematical purposes. Let's say that you have roughly $90,000 in revenue coming in, and that you have roughly $30,000 or $33,000 in cost of goods. That means that your profit margin is roughly about $56,000. That's how much profit you have after the cost that you paid for the goods that you're going to turn around and resell. That's a 63% profit margin. Great. That's awesome. Then comes expenses. Expenses come into play in a couple of different fashions. You look on your income statement, it's going to have expenses, which could be salaries, it could be marketing, it could be administrative, advertising. A lot of times we'll call it SG&A, sales and general accounting expenses. Let's assume that we spend about $35,000 or so in our expenses. So we made $90 in our business. It cost us $30 to buy the stuff we're going to sell, which gave us $56,000 net that we're going to use to run our business. Now we have all the various expenses, drops us down to roughly somewhere in the neighborhood of about $34,000. That now stands for Ebitda, earnings before interest, taxes, depreciation, amortization, or we get our gross profit margin percentage. So let's say that our Ebitda is $34,000. Now we're going to drop down to our depreciation amortization, which brings us to EBIT, which gives us roughly $27,000. Then we have the interest that we may have paid on our loans plus our current taxes, which gives us a net earnings of $15,000. That's right, we made $90,000 top line revenue. We earned $90,000 in revenue, but we only had $15,000 left over. That means we have a profit margin of 17.5%. Well, Justin, that sucks, man. I made 90 grand and all I get to put in my pocket is roughly 17.5%. That is profit margin. See, most business owners don't think this way. We don't think in the terms of how much money I make. More importantly, how much money do we get to keep? Whenever you're looking at profit gap, you're actually trying to determine what is my profit margin? What is my profit in my company? And is it below average or above average relative to my particular industry, relative to my industry? You say, Justin, why does it matter? It does. It matters a lot. So let's go back to lawyers. For example, in a law firm, there's not as much overhead as there would be in a construction company. In a construction company, you may have tractors and bulldozers and semis and various types of insurances that cover all that stuff. So you may end up having more overhead in a construction firm compared to that of a law firm. So whenever we look at this idea between profit gap, we first have to know what is our profit for us personally. Once we know the profit that we particularly are making in our business, then and only then can we drive into our business and say, can we improve our particular company? Can we improve our company? Before we drive any further, let's have a word from this week's sponsor.
We all know the old adage, work on your business rather than in your business. The professionals of Heritage Business Advisors will help you to improve your business's value using such tools as strategic planning, operational efficiency strategies, and risk management. To find out more about how we can help your business, visit heritagebusinessadvisors.com.
So we're talking about this idea of profit gap. And we've realized that profit is actually a margin. We're trying to figure out our profit margin. And we derive that by calculating the amount of income minus our cost of goods, minus our expenses, and I'm going to use expenses altogether, and that gives us our net earnings. If we take our net earnings divided by our total revenue, it gives us our profit margin.
Growing a business's value can be a time-consuming process. Rather than trying to explain every step to your team, have Justin Goodbread come to you. With his engaging style and unparalleled training, Justin presents the process to your team while seeking to align the team to your vision. For more information about training and speaking opportunities, visit financiallysimple.com/work.
Once we have our profit margin, that particular percentage rate, then we can see how do we stand in our particular SIC code, SIC code, or NAIC code compared to other industry professionals. So if we're comparing a law firm, we want to compare it to other lawyers. If we're looking at a construction business, we want to compare it to other construction firms. But we want to compare apples to apples. So that's why I say look at SIC code or NAIC codes. Because law firms, you may be dealing with a divorce lawyer, a divorce firm. Compare that to an intellectual property firm compared to a litigator estimator, compare that to an estate planning attorney, to a tax attorney. You have all these different types of firms. Same thing being the construction. Are we talking about road construction? Are we talking about swimming pool construction? Or are we talking about putting shingles on a house? They're all different types of work. So we want to compare our company to the industry. Now, before you say, well, Justin, 17.5%, as I mentioned earlier, that's awful. I made 90 grand and all I profited was 17.5 or $15,667. That could be an amazing return. That could be amazing profit margin for you. See, a good margin is going to be very considered by the industry, but as a general rule of thumb, 10%. A 10% return on that business is an average number. 10% is an average number. And that study comes from the Corporate Finance Institute. They show that small business owners as a whole, and that's not fair to do, can average around about 10% net profits. 20% is often considered a high margin, and 5% is often considered a low margin. So in your mind's eye, I want you to go back and look at a bell curve. You remember the bell that we've talked about through on the show. I want you on the left side of your bell, as you're drawing this in your mind's eye, I want you to think about 5% being a low margin. And on the opposite side, I want you to put 20% being a high margin, with 10% being the apex or the pinnacle or the corona, if you will, of the bell, the steeple of the bell, okay? I want you to put the 10% at the top there. So in your particular business, you may calculate this and say, okay, I had $1 million in revenues, but I only had $100,000 in net income, thus a 10% margin. You may find out that 10% is average for your particular industry, and so you're like, okay, I'm average. But the profitability gap is not trying to measure average. We don't want to be average. We want to be exceptional. I don't know about you, but I want to be really, really good at running a business. I want to be really good. Well, if that's the case, then I need to know where best-in-class businesses like mine, and with all the similar characteristics, what their profit margins are. And there are ways to study this. Most industry firms or industry associations will provide you this data point. I was looking at dentists, for example. It's not uncommon for us to try to shoot to a 30 to 35% profit margin in a dentistry, in a dental profession. I was looking at the financial profession. It's not uncommon for financial professionals to look at a 35 to 40% profit margin. It's not uncommon for large firms that are in large construction businesses. I'm talking about macro construction, you types you see the skyscrapers on, for them to have a 5% spread. And candidly, even in some of the technology world, it's not uncommon to see a 1 to 2% margin rate. It's not uncommon. It just depends on where you're at in the industry. So my first challenge to you is this: calculate your net profit margin. What is your profit margin for your company this year? After you calculate it for the year 2020, which may be dismal for many segments of our small business community, go backwards. What was it for the year 2019? What was it for 2018, 2017, 2016? Do you have a trend showing that your profit margin is increasing? As you're working to increase your profit margin, we have to have a target. We got to close the gap. What is the target? Who is it in your particular industry that you look up to? Who is it in your particular industry that when you go to your trade shows, whenever we're back to do that again after COVID, who is the individual or the firm or the business that is there teaching others how to do business in your code, in your SIG code, I should say? See, if I'm looking at a dental community and I see that I know dentists who are just rock stars who are producing almost a 40% marginal take-home rate, and that's not an anomaly. They're on the right side of the curve. They're on the profitable side of the curve, but yet a client is only producing 20, then I can say that there is a 20% profit gap, a profitability gap in the business. And if we could generate 20% more profit out of the company, what would that do to the business owner, his mind, her mind, their personal finances, their goals, their aspirations? I got to tell you, many people don't need an extra 20% in their profit margin. They need 2, 3, 4, 5. Years ago, Chris Snyder, who put this heading on my first book, The Ultimate Sale, Chris Snyder was the president and CEO of the Exit Planning Institute. He made this statement during training one day. He said, 5 by 5 by 5, 5 by 5 by 5. In fact, I've talked about this. I've given him credit. He's been on the show. We've talked to him about this concept of 5 by 5 by 5. The idea being that if we can increase our revenue by 5%, decrease our SG&A, our expenses by 5%, thus and increase our margin by 5%, we've had a rock star type of a year. My challenge to you is this. For today's particular episode, what is your profit margin? What is that number? Number one. Number two, what is the profit margin of best-in-class businesses? Once you know those two numbers and you calculate if there is a spread, what would your life do? What would you do differently in your life if you had the difference in your pocket? So let me give you that example again. Let's say that I know dentists that are producing a 40% profit margin, pretty standard and pretty. It's not an anomaly. It's not like the one-off. It's very common. They're best in class producing 40, but yet this dentist is only producing 20. There's a 20% difference. If it's $1 million, if they have $1 million of revenue, that's $200,000 difference. In your particular company, how would your life change? How would your business change? How would your wealth gap change if we could capture that profitability gap? If we could close that gap and get your business more aligned with those who are best in class? We're going to talk about that in our next episode. We're going to talk about how do you close the profitability gap. But today I want to outline what is the profitability gap. It's where you're at and where a best-in-class business is on a profit margin position. What is it? How do you calculate it? You take your total revenue minus your total expenses, give you your earnings. Your earnings divided by your total revenue gives you your percentage. Talk to your industry peers, talk to a consultant, talk to others within your industry and find out what is the best in class. What are the leaders of your industry? How much are they profiting total revenue on their profit margin? And then the difference. And there's your profitability gap. If we know that number, now we know how we can affect and drive more dollars to your particular pocket. Hey guys, it's Justin Goodbread here, Financially Simple. Look, I realize that life is hard. I get it. Life is hard, but life is good. We are a blessed people. I woke up today singing how blessed I am. I'm amazed at how good I have it, how great God's been to me in my life. I'm a blessed person. Life is good, life is hard, and life can be frustrating, but money doesn't have to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day. This tip is for informational purposes only. Please speak with a competent financial advisor regarding your specific needs. Justin Goodbread is a registered investment advisor with Heritage Investors. Visit heritageinvestor.com, financiallysimple.com for additional information.